What if I told you that the entire stock market, your retirement, your entire financial future is balancing on a knife's edge, propped up by just 7 companies? And what if I told you we have seen this exact movie before the year is 1998? The world is gripped by a frenzy for the internet. Brand the new companies with catchy.com names are appearing from thin air. And every single investor is absolutely convinced they have discovered the next revolutionary force in human history. So you take all of your savings, your hopes, your dreams, and you pour it into a handful of these promising tech stocks for 2 glorious years. Your money multiplies. It goes up and up. Your friends and family think you are an absolute genius until the year 2000. The bubble bursts and NASDAQ plummets by nearly 80%. Almost half of all .com companies simply cease to exist. Vaporized in an instant. Fortunes were wiped out overnight. People lost everything. The crazy part, the investors were right about the technology, but the hype, the overconfidence, the collective delusion created one of the most devastating bubbles in modern history. I am telling you this because today I feel that same electric, dangerous energy in the air all over again. But this time it is not being driven by the internet. People are calling it a once-in-a-generation opportunity, a guaranteed path to unimaginable wealth. And perhaps they are right, or perhaps it is the exact same story playing out with a new cast of characters. History rarely repeats, but it often rhymes. Every generation believes they are witnessing a new era. But as the legendary investor John Templeton famously warned, the 4 most expensive words in the English language are, "This time it's different." So the question we must ask ourselves is this time actually different? Before you make a single move with your money, we need to take a step back and look at the 3 hidden forces powering this potential EV thing, and what you can do to navigate the incredible mayhem that is coming. Right now, as we speak, the destiny of the global stock market and your personal portfolio is being dictated by a tiny handful of corporate giants. Just 7 companies. They are called the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia together. These 7 titans now account for around 36% of the entire S. They are all locked in a brutal, high-stakes arms race to achieve total dominance over the field of artificial intelligence. This means that even if you only own a single share of a basic S&P 500 index fund, you are already making a massive bet on these companies, whether you realize it or not. Every single dollar that these companies invest sends powerful ripples cascading through the entire market, affecting everything from chip manufacturers to energy providers to the very index funds you hold. And when you see the staggering amounts they are projected to pour into AI, the sheer scale of this phenomenon. Let's break it down one by one. Tesla plans on spending $5 billion on autonomous driving and xAI, which is Elon Musk's great new artificial intelligence startup. Apple is committing a staggering $107 billion to make Siri smarter, though frankly it will probably take even more than that. Meta is investing $60 billion into its data centers and the metaverse. Google is spending $75 billion to rebuild the entire internet with artificial intelligence at its core. Microsoft is funneling $80 billion into funding OpenAI and building a fleet of supercomputers. And Amazon is spending $100 billion on its Amazon Web Search in one single year. To put that number into perspective for you, that is more than the entire gross domestic product of developed nations like Finland or Portugal. All of this capital is being deployed to construct the future. Some are even calling this the 4th industrial. Rather, there is a darker side to this story. All of this concentrated spending appears to be the primary force keeping the entire economy afloat at this moment. Without it, the United States might already be slipping into a mild recession. So the critical question becomes, how long can this possibly last? Well, it does not seem to be ending anytime soon. Global spending on AI is expected to skyrocket to $500 billion by the end of 2026. The spending on power and resources just to meet the electricity demand for these systems is projected to top $3 trillion annually by the year 2030. That is how desperately these companies want to win the AI arms race. The International Monetary Fund estimates that approximately 60% of all jobs in the developed world are exposed to artificial intelligence. This means they could be fundamentally transformed, or worse, entirely replaced by automation in the coming years. Therefore, whoever manages to crack this stick out of power and control. Mark Zuckerberg even stated that if Meta ends up misspending $200 billion in this pursuit, it's a worthwhile price to pay. Because if they move too slowly, they are completely out of the competition. But this race is no longer just between companies. It has escalated into a battle between nations. The United States and China both view AI as the ultimate key to global dominance, and they are both burning through billions upon billions of dollars to ensure they are the ones holding the reins of power. For the everyday investor, this situation could diverge into two very different paths. If AI delivers on its revolutionary period in the internet boom of the 2000s, but if the monumental profits fail to materialize quickly enough, the very same stocks that are pumping up your investment portfolio today could be the ones that drag it crashing down tomorrow. But where is all of this money actually coming from? That brings us to the second hidden force. This is what's being called the AI money machine, and it is the main reason I am growing increasingly concerned about the true health of the arch. Let me walk you through exactly how this complex system operates. At the top, you have companies like Intel, AMD, and NVIDIA. These are the businesses that design the incredibly powerful chips that are the brains behind the AI models. Then you have companies like OpenAI. They're the ones who buy these specialized chips in massive quantities. In the middle, you have companies like Oracle and CoreWeave. These are the data centers who also purchase these chips and then lease out the immense computing power to the AI companies. Think of them as the landlords of the digital world. At first glance, nothing here seems particularly unusual. But once you begin to examine how these companies are actually working together, the red flags start to jump out. It all began when investors in Microsoft provided OpenAI with $58 billion in funding. OpenAI right back to Microsoft in order to use their data centers. Microsoft then used that revenue to buy enormous quantities of chips from NVIDIA. In a stunning turn, NVIDIA then invested a portion of that money right back into OpenAI. This circular flow allows each company to record the movement of money as new revenue, which of course helps to push their stock prices ever higher. It is a bit like if I went out into the woods with a friend and paid him $1,000 to dig a giant hole. Then he turned around and paid me $1,000 to fill that same hole back in. At the end of the day, no real value was created, but we can both report $1,000 in revenue on our books. Now, if our hole digging business were valued like a company such as OpenAI, which is currently trading at more than 40 times its revenue, that would mean our meaningless venture would suddenly be worth over $40,000. Of course, I am simplifying things quite a bit here. These companies are not just passing the exact same dollar bills around in a circle. However, the underlying principle remains disturbing. And then NVIDIA agreed to invest up to $100 billion back into OpenAI. But here is a catch: to unlock that massive investment, OpenAI has to buy even more of NVIDIA's chips. NVIDIA are without a doubt the biggest winners in this whole arrangement. Their share price has exploded by a mind-boggling 1,600% since ChatGPT was first launched. They sell their essential chips to everyone: Microsoft, Meta, Google, Amazon, OpenAI, and even Oracle. Then they take the profits and invest back into the very same companies that buy their products. This is dangerously close to paying your customers to buy your own product. And it could be art-tangled and messy. This all becomes. Let me simplify it even further. NVIDIA sells the shovels, Oracle provides the land, OpenAI digs the quarry, and they are all helping each other to lure more and more people into their gold mines. The only problem is nobody has actually struck any significant gold yet. Consider this: OpenAI is currently valued at $500 billion, but it is only generating. It is losing money every single month. And that is the central problem I see with this entire situation. The AI services themselves are simply not making enough money to justify these R&I companies ever generate the kind of profit needed to sustain their stock prices. Well, it is certainly possible. They do still have some huge levers they can pull. Each week, over 700 million people are using ChatGPT. That represents a colossal amount of consumer attention and, more importantly, an enormous repository of data about all of us. Imagine the day when Sam Altman decides to turn on advertisements and allows corporations to use ChatGPT to recommend their products directly. It could be a form of marketing unlike anything we have ever experienced before. On top of that, these AI companies are building systems that aim to undercut the human workforce. They are betting that once corporations become fully dependent on AI, they will have no choice but to keep paying for the service, no matter what the cost. And that is the moment when the AI companies could hike their prices to astronomical levels and finally cash in on their investment. So there is no doubt that these AI companies are valuable. But much of that value still hinges on one critical assumption: the belief that progress will continue to accelerate at its current dizzying pace. Artificial intelligence has been improving at a truly breakneck speed for the past couple of years. We have gone from AI-generated video that looks clunky and strange to something that is nearly indistinguishable from reality. It has become a running joke that Will Smith eating spaghetti is now one of the primary benchmarks we use to judge the progress of AI. The entire stock market is relying heavily, perhaps completely, on this rapid rate of improvement to continue indefinitely. However, we are not far off from hitting a monumental obstacle known as the data wall. For years, AI models have been devouring every single scrap. A public data available. It is like climbing a ladder that you assume goes on forever, but we are quickly running out of rungs. We are running out of data to climb. Soon we might have to start moving one slow square at a time instead of leaping forward. Just think about how long the step teams that we are feeding to AI have taken humanity to build. We have been feeding it every book, every research paper, and all the data going back through human history. It is no wonder the progress has seemed so miraculously rapid. But what happens when the well runs dry? If AI companies cannot find a clever way to scale beyond the data wall. But is beating the data wall actually possible? Potentially. Think about it for a moment. Humans do not have to worry about this data limitation. That is because we do not just learn from being fed static information from the past. We learn from actively interacting with the world around us. My perspective comes from my experiences, my conversations. That is something AI in its current form cannot truly simulate. So in my opinion, scaling past the data wall is possible. But it is not just a question of finding more data. It is a question of finding a completely different kind of data, one generated through real-world interaction. But I am not a scientist, so let's get back to the world of investing and the stock market. I started this discussion by comparing what is happening right now to the dot-com bubble of the late 1990s, however. Is it truly the same situation? No, not entirely. The most significant difference is that today's AI companies have real, tangible, unproven path to generating massive profits. This is a much better situation than the dot-com bubble, where companies were achieving insane valuations based on nothing more than a fancy name and a vague business plan. So does that mean this is not a bubble? Honestly, I still believe that it is. The classic signs are all there: extreme overvaluation, questionable revenue streams, jeweling mania, and looming scaling limits. However, there is simply no way of telling what stage of the bubble we are currently in. This could be the very beginning of a decade of wild investment, or we could be much closer to the end than anyone realizes. So what is the best thing to do with your money in such an uncertain environment? I am not a financial advisor, but these are the principles I would be focusing on if I were in your position. Firstly, continue to invest consistently. If we are only at the start of this bubble, then the prices we are seeing right now could look like incredible bargains in a few years' time. That is why it is so critically important to set up an automatic investment that leaves your account every single month and goes into a broad, low-cost index fund I followed this exact strategy during the dot-com bubble. The real secret is not to panic when your portfolio value goes down, as long as you are invested in a diversified index fund that tracks the overall stock market. Then continuing to invest through a crash could be the single best financial decision you ever make. That is how fortunes are truly built. But to do this successfully, you must ensure you are not in debt or over-leveraging. Secondly, focus on increasing your income. Your income is the fuel you are using to grow your wealth, so if you can increase it by getting a promotion or starting a side hustle, that will supercharge your long-term returns. This is especially powerful if you can do it while the stock market is falling, because you will be picking up high-quality assets at bargain prices. Thirdly, and most importantly, focus on diversification. Putting all of your money into one single type of investment is a recipe for disaster. The key to surviving market bubbles is to spread your money across different types of assets. My personal portfolio includes Cray Estate and even some Kaikokes. It is also worth considering dividend-paying stocks, as they tend to perform well during market downturns because they generate passive income even when stock prices are low. Just remember, this bubble bursting, if and when it happens, will not be the end of the world. If you understand situations like this, you will not be the one panicking. You will be the one who remains calm, sticks to your plan, and takes advantage of the incredible opportunities that arise while everyone else is running for the exit. If you found this analysis tickle, be sure to subscribe for more content like this. Thanks for watching.